Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to treat accounting for royalties. Royalties account, or how to account for royalties. And we're going to start by me trying to explain the concept of royalties and then how operations are done before we zoom into the accounting arrangements. Now, what is royalty? Now, let me say this, that there are times where the owner of a legal right, okay, may as a result of business allow another person or entity to use that right in exchange for some money. So you have a right, you allow someone to use that legal right in exchange for some money. The money that you are being paid or the money you also pay for using someone's right is called royalty or royalties. And so there is going to be a royalty payment if you use someone's right. Now, the legal right could be in three forms. It could be a copyright, it could be a patent right, or it could be a mineral right. Now, a copyright is a right to copy someone's work, okay? And then a patent right is a right to use a patented process or a device. And then a mineral right is a right to extract oil, gold, or any other mineral from the land. That belongs to someone. And so let me use the mineral rights in this case to explain the concepts to you beautifully. And then when I'm done, we'll take questions that will apply to any of them. Now, looking at the mineral right, for example, we know that you, the owner of the right, when you allow someone to use your right, the one who is using the right pays you some money. And that money that you are going to be paid is called royalties. Okay, so if you own a land and you give it to a mining company or any other person to extract gold or oil from the land, you charge them royalties. So at the end of every year or at the end of every month or whatever agreement that you sign with them or with him or her, the entity or the people that are using the rights will pay you an amount called royalty. If you are an author and someone is using your book for personal gains, the person has to come for the copyright and then pay you some royalties. That is the meaning. Now, these royalties that is going to be paid to you. Okay, so in this case, let me call you the owner of the land, the landlord. And then let me call the user the tenant. Now, there's going to be a contract between the landlord and the tenant or the user of the right. And the user of the right must pay an amount of money every year or every 6 months or whatever period that is agreed to the owner of the right or the landlord. Now, this is what you should understand, that the amount that you are going to pay, which is called royalties, okay, the amount that you are going to pay, the royalty payment is based on output. Is based on output. What do I mean by it is based on output? That is the first thing you should understand with this. The royalty payment is based on output. What do I mean by it is based on output? Now, let's say you can go into agreement that you are going to extract oil from the land that belongs to a particular community. So you are going to pay royalties to the community. So they can agree that for every ton, so for every ton of oil that you extract, you are going to pay, let's say, $5 per ton. And so it means that if at the end of the period you extract 100 tons of oil for the year, you are going to multiply by $5 and pay royalty of $500. So this is the royalty payment that you are going to do at the end of the year. So that is what I mean by royalty payment is based on output. So that is the first principle you should understand, that royalty payments are based on output. Then the second thing you should understand is that there could be something called minimum rent. So let me give you the principles here based on output. So these are operating arrangements. So royalty is based on output. Then the second one is that there could be minimum rent, or there could be minimum payment, What do I mean by minimum payment? There could be a minimum royalty payment, and this is what I mean by minimum. You know, when you go and then seek for permission to use the land, and then the agreement is signed, and you are told that for every ton you pay $5. Now, the landlord could also tell you that no, even though for every ton you pay $5, I am going to take a minimum. You can call it minimum rent payment or minimum royalty payment. A minimum royalty payment of, let's say, $1,000. This is the minimum I will take every year. So there could be a minimum. So because we all know that at the early stages of production, or sometimes, or there are some years where output will be very low. So in this case, if the company is able to extract only 100 tons and they multiply by 5, they are going to get $500 as their royalty payable that they are going to pay to the landlord. Meanwhile, the landlord has set a minimum royalty payment of $1,000. And so you need to top up. Where you are going to get the money from, we don't care. So you top up with an extra 500 to make it 1,000, and then you pay. So this extra you are topping up is a loss to you, the business. You didn't make that much gain, but you are paying because there is a minimum set. So because the minimum is set, the difference is a loss. And this loss has a technical name in royalty accounts. We call it short workings. We call this loss short workings. And so you are going to incur short workings of 500. Now, in the following year, if you extract and you get, let's say, 400 tons, you multiply by 5, it means you are supposed to pay 2,000 as your minimum or as your royalty payable. Now, listen very carefully. It is the minimum that is $1,000, not the maximum. As for maximum, it could be any. So even if you are getting $20,000, we will take it. The landlord will still take it and thank you very much. But you dare not pay below the minimum. And so if you are getting 2,000 for the subsequent year as royalty payable, it could be in the agreement that, you see, this laws that you made in the previous year, the landlord could be lenient enough to allow you to recover that or to recoup that. Okay, and so because in the previous year you were supposed to pay 500, but because of the minimum you had to pay an extra 500. So in the following year that you have gotten 2,000, the landlord can agree for you to subtract the loss of 500 from the 2,000, so that this year you can now pay only 1,500. In other words, you have recovered the short workings, you have recovered the loss, you have recovered or you have recouped your short workings, and so you are allowed to subtract the short workings, and then you pay the difference of 1,500. Now, please take note that it is not always automatic that you have to always be allowed to recover the short workings or the loss. What is that? Whatever happens will be different from case to case basis, and it will depend on the agreement you sign. Most cases, short workings are given limited time to recover. You can be told in the contract that any short workings you make could not be recovered after 5 years or after 3 years. So it means that if you make any losses within the first 3 years, you should be able to recover them. Other than that, when it exceeds the 3 years, all of that will be written off as losses or as to the profit or loss account, meaning that you have lost. So you need to work hard to recover the short workings based on the agreed time. It could be 5 years, it could be 2 years, but it depends on the agreement. And every question will come with a different agreement, and every contract comes with a different agreement. So I just want you to understand the fact that, 1, royalty payments is based on output. 2, there could be a minimum payment that will hinder you, so that even though you are not able to raise up to that amount for the landlord, you still have to pay the minimum. And then the third thing you should know is that royalty payments are done in arrears. So payments made in arrears. That is the third principle you should understand. That royalty payments are made in arrears. In other words, the royalty that is payable, the royalty for 2021 will be paid in 2022. Royalty for 2022 will be paid in 2023. That is the meaning, and that is what I mean by payment of royalties are also done in arrears. So you should understand that as well. All right. So we having understood these three and then having understood the concept of short workings, so I can say that the fourth should be short workings could arise and the fifth could be short workings could be recovered. So you can just know that the fourth, short workings could arise, short workings could be recovered in subsequent years. So I'm going to clean the board and then explain something called the working schedule. So I'm going to use some imaginary figures to explain to you how it is done. Then I'll show you how accounting procedures should also be done. And then from there, we will take a question and then solve it together. So let us consider the accounting arrangement, okay? Now, when we talk about the accounting arrangement, we have to look at it from two different angles. In the books of the tenant, or the one who is exercising the right, and in the books of the landlord, the one who is giving out or allowing the right. Now, the tenant will open books or accounts in his books, and then the landlord is also expected to do so. But in many cases, practically some of the landlords may not, but it's always understandable that the landlord will also have to prepare some accounts. So we have two different categories. We have accounts that will be prepared in the books of the tenant, and then accounts that will be prepared in the books of the landlord. And in this case, the tenant is the one that is extracting or using the right, and the landlord is the one that owns the right, the owner of the right. In these cases, who I'm calling the landlord. So there should be accounts in the books of the tenant and accounts in the books of the landlord. So I'm going to teach you both. Okay. So we are first going to focus on accounts in the books of the tenant, because that is the most important one, or the one that is using the right. Because usually you have to prepare accounts and then you have to show all these things. So we are going to prepare. But the interesting aspect is that they are opposite in nature, and I'm going to explain to you. Now, in the books of the tenant is going to prepare three key accounts. The tenant is going to prepare the royalty payable account. And then the tenant is also going to prepare the landlord's account as a creditor's account. So when I say the landlord account, if you know the name of the landlord, you show. If you don't know the name, you can just say landlord account. But in your mind, it is a creditor's account. So you prepare the landlord account. And then in the books of you, the tenant, you prepare short workings recoverable account. So these are the three accounts that will be prepared in the books of the tenant: the royalty payable account, the landlord account, and the short workings recoverable account. Now, in the books of the landlord, because you see, the tenant sees the landlord as a creditor, but the landlord sees the tenant as a debtor. Okay, so the landlord is going to prepare royalty receivable account. So you see, whilst the tenant is preparing royalty payable, landlord is preparing royalty receivable account. And then in the books of the landlord, you prepare the tenant's account. In this case, the tenant is a debtor. And then also, the landlord will prepare short workings allowable account. So that is it. So look at the difference. The tenant is preparing royalty payable, landlord is preparing royalty receivable. Tenant prepares landlord account, landlord prepares the tenant account. The tenant prepares short workings recoverable because he will be hoping to recover all those short workings that I explained to you. And then the landlord will also allow him to recover. So short workings allowable account. And then that is the accounting treatment. So we are going to focus first on the accounting entries for the tenant, and then afterwards we will do for the landlord. The only good news is that it will be the same figures that you are going to use to prepare this and that, just that the accounts are going to be opposite in nature. But before we prepare these accounts, we need to understand something called a working schedule. If you don't do that working schedule, you cannot prepare the accounts. Because the working schedule is going to give you the figures that you need to prepare all these accounts. And so I'm going to teach you how to prepare the working schedule. Right after teaching the working schedule, we will take a question and then we'll prepare accounts in the book of the tenant. And then we'll use the same question to prepare in the books of the landlord. All right. But before that, let me also add that the royalty payable account is an expense account. This is an expense account. So it will be written off to the income statement or the profit or loss account or whatever account that you may have, whether you call it operating account or profit or loss account. The royalty payable looks more like an expense account. The landlord account is a creditor account, like I said. And then the short working account, whatever balance that is left will be taken as a current asset. I'll talk about that when we are explaining. So I'm going to teach you how to do that. But let us first learn how to prepare the working schedule. Okay. Now, we are going to learn how to prepare the working schedule. And like I told you, without the working schedule, you'll not be able to prepare the accounts. And so let me show you how to do that. So you say working schedule. You underline it nicely, and then you begin. Look at how I'm going to show you. The first thing you write is the year, and then you come to output. And then the next item is the royalty payable. From the royalty payable, you show the minimum payment. And then you come to short workings. Now, after the short workings, you show short workings recovered or recouped. And then the last thing is short workings written off. So this is how to go by the working schedule. You start with the year, the output, royalty payable, the minimum rent, the short workings recovered, and then short workings written off. So that is how to go by the working schedule. So usually you put your currency sign under each of these, with the exception of the year and the output. The output could be bags, tons, units, whatever that they will give. Now, so what we are going to do now, look at what I'm going to do. I'm going to make it very practical so that you understand how to prepare the working schedule. Now, assuming that in year one, so normally the question will give you the agreement, which is the amount that is being paid per output. So if the amount paid per output is $5, then if in year one, you are able to extract 500 units of the product from the ground, maybe if it's oil, 500 tons, you multiply 500 by what they have given you in the question, which is the $5, and you get 2,500. So you put that here as a royalty payable. Then the minimum rent will also be given in the question. Usually, okay, let's assume it's 1,000. So minimum is 1,000. So in this case, the royalty payable is more than the minimum. So there are no short workings. Remember, I've explained the concept of short workings. That is when you don't get the minimum. Then the difference is called short workings. So there will be no short workings. And once there are no short workings, everything about short workings become blank. Because we don't even have short workings to think of recovering or to write off. So that is it for the first year. Now let us also, I'm only using assumptions to make the thing very understandable. So let's look at assumption 2 in year 2. Let's say with the same, you are able to produce 100 units. So if you multiply 100 by 5, you have $500. Whilst your minimum payment maintains at 1,000. The minimum payment does not change. Please take note. So it's 1,000. Now, your royalty payable is below the minimum payment, and therefore there is short workings. The difference of 500 will be called short workings. Now, short workings cannot be recovered in the same year that it is incurred, and so there will be no recovery, and in the same way there will be no written off. That is the meaning. In the third year, assuming that you were able to produce 300 units, if you multiply 300 by 5, you have 1,500, whilst your minimum payment is still 1,000. So you see that If the agreement allows you to recover or recoup short workings in the subsequent year, then this 500 could be recouped because the difference here is exactly 500. And the $500 can recoup or recover the previous year's short workings. So even though royalty payable is 1,000, but in accounts you see that we'll end up paying only 1,000 to the landlord because the extra 500 will recoup the previous year's short workings. So what you need to do is that 500, you write it under the short workings recouped as 500, and then that is it. Once you have been able to recover it, then it means you are not writing off the short working. It will not be, when you are writing it off, it's becoming an expense to you, but you are not writing it off. So because you have been able to recover it. Now let me change the scenario a little bit. Let me just clear this and then also assume that in the second year, you were able to extract only 30. If you're able to extract only 30, you multiply 30 by 5, you are going to get $150. Now, if you compare $150 to the minimum payment, you are going to get short workings of $850 in the second year. So that means that in the third year, assuming that you have the same 300, okay, which is going to give you a royalty payable of 1,500 and a minimum maintains at 1,000. You cannot recover all the 850 because the difference between the payable and then the minimum rent cannot pay all. So it's only the extra 500 that you can use. So it means that in this case, you are going to recover just a part. So you recover 500. You write only the 500 and the short workings recovered or short workings recouped. Now, if your short workings recovered, or let's say the agreement permits you to recover short workings in 2 years period, then it means that you are not writing anything off because the extra 350, you are recovering 500 out of 850. So the extra 350 could be recovered in the subsequent year. However, if the agreement stipulates that short workings could be recovered only in the next year and no other year, then it means that you couldn't recover all. So now that you have recovered only 500, the extra 350 that you cannot recover will be written off as short workings written off. So whether you are going to write it off or you wait till the next year depends on the agreement. And the agreement will be stipulated in the contract. And in this case, if you are using it to write an exam, the agreement will be stipulated in the question. And you need to use that to prepare the working schedule. Because once you are able to do this very well, that is when you can be able to prepare the accounts very well. If this is not done very well, the accounts will not be able to be correct because the figures that you are using here is what you are going to use to prepare the account. So if you are not able to do this very well, I'm afraid your account will not be proper. So the royalty payable column will be used to prepare the royalty payable account. You debit royalty payable and then you credit the landlord account with this because the landlord is a creditor. So you credit the account with this because I told you payment is done in arrears. So any payment for each year will be paid will be done in the next year. So you credit the landlord's account with this in your books and then you debit the royalty. I'm talking about the account in the books of the tenant. So you debit the royalty payable as an expense account and then you credit the landlord account with this. And then I'm going to show you how to deal with the short workings when we are solving a question. So this is how to prepare the working schedule. Now, the next thing we are going to do is we take a question, but that is going to be in the part 2 of this video. We are going to take a question, and that is going to help us prepare accounts in the book of the tenant, as well as preparing accounts in the book of the landlord. Remember to subscribe to this channel if this is your first time. Share this video and let others also have a benefit. And until we meet again for the part 2 of this, it is bye for now.